In the early morning of December 15, 2025, as financial analysts across the globe pored over freshly released data from China's National Bureau of Statistics, a stark reality emerged from the numbers. Fixed asset investment, the backbone of China's economic miracle for decades, had contracted by 2.6% year-on-year for the January to November period, marking a steeper decline than the anticipated 2.3% drop and signaling the first annual fall in over 3 decades. This was not a mere slowdown. It represented a profound unraveling, driven predominantly by the real estate sector's freefall, where new home prices tumbled 2.4% from the previous year, extending a 4-year downturn that now appeared irreversible. In Beijing's corridors of power, officials scrambled to project stability, but the data painted a picture of a crisis entering its terminal phase, one that threatened to drag down not just China's economy, but ripples across the world. What had begun as a controlled correction in an overheated property market had metastasized into a systemic threat, exposing the fragility of a growth model long reliant on bricks and mortar. To fully appreciate the magnitude of this moment, we must first explore the foundational elements of China's economic structure, particularly fixed asset investment and its intertwined relationship with real estate. Fixed asset investment, often abbreviated as FAI, refers to the capital poured into long-term projects that build physical infrastructure, factories, and housing. In simple terms, it is the money spent on constructing bridges, expanding manufacturing plants, or developing residential complexes, assets that are fixed in place and contribute to future productivity. In China, FAI has historically accounted for over 40% of gross domestic product growth, serving as the engine of the country's rapid urbanization and industrialization since the economic reforms of the late 1970s. Unlike consumer spending, which fluctuates with household incomes, or exports, which depend on global demand, FAI provides a reliable lever for policymakers to stimulate the economy during downturns. It is divided into 3 main categories: infrastructure, such as roads and railways; manufacturing, including factories and equipment; and real estate, encompassing residential and commercial developments. Real estate, in particular, has been the dominant force within FAI, often comprising up to a quarter of China's total economic output, when including related industries like construction materials and appliances. For context, imagine a system where property development is not just an industry, but a national savings vehicle. In China, households have traditionally funneled their wealth into real estate, viewing it as a safer bet than volatile stock markets or low-yield bank deposits. This created a virtuous cycle. Rising property values encouraged more investment, which fueled construction booms, job creation, and local government revenues through land sales. By the mid-2010s, real estate had become so central that it supported millions of jobs and underpinned the financial stability of provincial administrations, which relied on land auctions for up to 30% of their fiscal income. However, this model rested on an assumption of perpetual growth, ignoring the risks of overbuilding and debt accumulation. The seeds of the current crisis were planted in the aftermath of the 2008 global financial meltdown, when China unleashed a massive stimulus package worth 4 trillion yuan, equivalent to about 13% of its GDP at the time. This influx of credit turbocharged infrastructure and real estate development, averting a recession but inflating a property bubble. By 2020, housing prices in major cities like Beijing and Shanghai had soared to levels rivaling those in New York or London, far outpacing wage growth and creating affordability gaps. Developers, emboldened by easy access to loans, borrowed heavily to acquire land and build vast complexes, often pre-selling apartments to buyers who paid up front for units that might take years to complete. This pre-sale model, unique to China, allowed companies to finance expansion without immediate delivery, but it also sowed vulnerability. If sales faltered, cash flows dried up, leaving projects unfinished and buyers in limbo. The turning point came in late 2020, when Beijing introduced the 3 Red Lines policy to curb excessive leverage in the real estate sector. This regulatory framework set strict limits on developers' debt ratios. Liabilities could not exceed 70% of assets, net debt could not surpass equity, and short-term borrowing was capped at long-term debt levels. The intent was prudent, to prevent systemic risks from over-indebted firms, but the implementation was abrupt, catching many off guard. Evergrande, China's largest developer at the time with over $300 billion in liabilities, became the poster ch. Illed for the crackdown. In September 2021, it missed bond payments, triggering a default that rippled through the industry. Buyers halted mortgage payments on unfinished homes, suppliers went unpaid, and banks tightened lending, amplifying the liquidity crunch. As 2022 dawned, the crisis deepened. Property sales plummeted by 26% year-on-year, and new housing starts fell by 39% as confidence evaporated. Local governments, starved of land sale revenues, cut spending on infrastructure, dragging down overall FAI. Beijing responded with piecemeal measures, lowering mortgage rates, relaxing purchase restrictions in smaller cities, and injecting liquidity into banks to encourage lending. Yet these steps failed to revive demand, as households grappled with COVID-19 lockdowns that disrupted incomes and heightened economic uncertainty. By year's end, over 20 developers had defaulted, and unsold inventory swelled to levels equivalent to 2 years of sales in some regions. Downward spiral accelerated in 2023. FAI growth slowed to just 3% for the year, with real estate investment contracting by 9.6%, the first annual decline in decades. Protests erupted in cities like Zhengzhou and Xi'an, where homebuyers demanded refunds for stalled projects. The government launched a whitelist program, directing banks to finance viable developments, but corruption scandals and misallocation undermined its effectiveness. Meanwhile, shadow banking, unregulated lenders that had fueled the boom, faced scrutiny, further constricting credit. By mid-2023, Country Garden, another giant, teetered on default, underscoring that the problem was industry-wide, not isolated to Evergrande. In 2024, hopes for recovery flickered briefly with stimulus announcements, including a 1 trillion yuan bond issuance for infrastructure. However, real estate sales continued to slide, down 10% year-on-year, as oversupply persisted. Ghost cities, once a meme, became reality in places like Ordos, where vast apartment blocks stood empty. Beijing shifted rhetoric, emphasizing high-quality development over sheer volume, but the transition was painful. FAI eked out minimal growth, buoyed by manufacturing upgrades in electric vehicles and semiconductors, but real estate's drag intensified, with prices falling in 69 of 70 major cities by December. By 2025, the crisis had entered what many analysts described as its terminal stage. The year began with tentative optimism following a Politburo meeting pledging to stabilize property, but data soon dispelled illusions. In the first quarter, FAI declined by 0.5%, the first quarterly drop since the pandemic. Real estate investment plunged 9.5%, with new starts down 27%. Stimulus efforts ramped up. In April, the central bank cut reserve requirements, freeing up 1 trillion yuan for lending, and cities like Shanghai eased home-buying rules for non-residents. Yet, sales volumes for the top 100 developers fell 37% in the first half, and prices dipped in Tier 1 cities for the first time in years. The summer brought escalation. In July, Vanke, a state-backed developer, reported its first loss in decades, signaling even safe firms were vulnerable. Protests resurfaced, with buyers boycotting mortgages on over 300 projects nationwide. Beijing responded with a bailout fund of 200 billion yuan to complete unfinished homes, but implementation lagged due to local resistance. By September, FAI had contracted 1.7% for January to August, with real estate down 10.2%. Infrastructure spending, meant to offset the slump, stalled as local governments grappled with debt ceilings. October and November data confirmed the collapse. FAI for January to October fell 1.7%, accelerating to 2.6% by November's end. In November alone, investment plummeted 11.1% year-on-year, the sharpest monthly drop on record. Real estate bore the brunt. New home prices fell 0.4% month-on-month in November, the fastest pace in a year, with secondary markets declining across nearly all cities. Sales for major developers dropped 36%, and inventory hit 27 months' supply, the highest ever. Vanke's crisis deepened, with shares tumbling amid liquidity warnings, while overall property investment contracted at double-digit rates. As December 2025 unfolded, the government's response intensified. At the Central Economic Work Conference, leaders vowed to step up urban renewal and stabilize housing, prioritizing affordable units over speculative builds. Yet, with FAI on track for its first annual decline since 1998, and property sales projected to end the year down 15–20%, the measures appeared reactive rather than transformative. Analysts from firms like Capital Economics warned of an outright collapse, with investment slumping 11% in the second half alone. Beyond the headlines, several less discussed factors have exacerbated the crisis, turning a manageable correction into a terminal affliction. First, local government debt stands at an estimated 90 trillion yuan, much of it tied to land sales and off-balance sheet vehicles known as local government financing vehicles, or LGFVs. These entities borrowed heavily to fund infrastructure, using future land revenues as collateral. As property slumps, land auction proceeds have halved since 2021, forcing provinces to curtail spending and delay projects, amplifying the FAI decline. In 2025, LGFV defaults rose, with hidden debt restructuring straining central finances. Demographics play a hidden but pivotal role. China's population peaked in 2022 and is aging rapidly, with birth rates at record lows below one child per woman. This demographic dividend reversal means fewer young buyers entering the market, while an oversupply of 7 billion square meters of housing, enough for 70 million people, looms. Urbanization, once a driver, has slowed to 65%, leaving rural migrants unable to afford city homes amid wage stagnation. Overcapacity in related sectors compounds the issue. Steel and cement industries, geared toward construction booms, now face idle factories, leading to zombie firms, unprofitable entities kept alive by subsidies. The IMF has highlighted this as a drag on productivity, with fixed asset overinvestment creating inefficiencies. Moreover, policy inconsistencies, tightening credit to deleverage while urging growth, have eroded confidence, deterring private investment. Externally, global headwinds like U.S. tariffs and supply chain shifts have diverted manufacturing FAI abroad, while commodity price volatility hits infrastructure costs. Less visible is the social toll. Millions of rotten-tail buildings, unfinished projects, have left families in debt without homes, fueling unrest and eroding trust in the system. The global implications of China's FAI collapse and terminal real estate crisis are vast and interconnected. As the world's second-largest economy, China's slowdown, estimated at below 3% growth in 2025, dampens global demand. Commodity exporters suffer. Australia's iron ore shipments, 80% destined for China, face price drops, while Brazil's soy and Chile's copper markets contract. In 2025, steel demand fell 5%, pressuring suppliers worldwide. Supply chains feel the strain. Multinationals reliant on Chinese manufacturing see delays from reduced factory expansions, while consumer goods like electronics face cost pressures from sluggish domestic demand. Financially, international banks exposed to Chinese developers risk losses, with spillover to emerging markets via Belt and Road debts. Environmentally, the crisis slows China's green transition, as infrastructure FAI shifts from renewables amid budget cuts. Geopolitically, the downturn heightens tensions. Beijing's push for self-reliance in tech diverts FAI from traditional sectors, potentially escalating trade conflicts. For developing nations, reduced Chinese investment means stalled projects, while advanced economies grapple with deflationary exports from China's overcapacity. In this thoughtful conclusion, as 2025 draws to a close on December 25, the collapse of China's fixed asset investment and the terminal progression of its real estate crisis stand as a watershed moment in economic history. What was once a symbol of unstoppable ascent, a skyline of cranes and endless growth, has revealed the perils of imbalance. The data from November, with its double-digit plunges, confirms a structural shift, where debt, demographics, and overbuild converge to defy quick fixes. Beijing's pledges for 2026, emphasizing urban renewal and affordable housing, offer glimmers of adaptation, but recovery demands painful reforms, debt resolution, population policies, and a pivot to consumption-led growth. Yet terminal does not mean irreversible. China's resilience, seen in past crises, suggests potential for reinvention, perhaps through innovation in green tech or services. The global community, intertwined with this giant, must prepare for prolonged adjustment, fostering cooperation to mitigate spillovers. In the quiet of this holiday, the story of China's economic unraveling reminds us that no model is eternal. Prosperity requires vigilance against excess, ensuring that today's foundations do not become tomorrow's ruins. The cranes may stand idle, but the path forward lies in rebuilding with wisdom. Arrives with the year concluding under a veil of economic introspection. The profound contraction in China's fixed asset investment has solidified into a defining structural downturn, with the real estate sector's protracted crisis showing few signs of reversal despite intensified policy interventions. The latest data for January to November revealed a 2.6% year-on-year decline in fixed asset investment, the deepest contraction on record for that period, and confirming an annual trajectory toward first full-year fall since the Asian financial crisis era. Real estate investment alone plummeted 10.4% over the same span, while new home prices extended their slide, falling 2.4% annually and accelerating in secondary markets across most cities. In the final weeks of the year, Beijing's Central Economic Work Conference outlined priorities for 2026, emphasizing stabilization through urban village renovations and affordable housing. Yet analysts projected only marginal relief, with fixed asset investment likely to contract further amid entrenched oversupply and subdued demand. The closing chapter of 2025 unfolded with mounting evidence of the crisis's depth. November's standalone figures underscored the severity. Fixed asset investment dropped 11.1% year-on-year, the sharpest monthly decline in available records, driven by an 18% plunge in real estate completions and a 27% fall in new starts. Sales among the top 100 developers contracted 36% annually, leaving inventory equivalent to 27 months of absorption, the highest ever documented. Major firms like Vanke issued stark warnings of liquidity strains, with shares suspended briefly amid restructuring talks, while smaller developers faced accelerated defaults. Local governments, confronting halved land sale revenues, deferred infrastructure projects, exacerbating the broader FAI slowdown. December brought a flurry of policy announcements at the annual conference, held mid-month. Leaders pledged to vigorously boost urban renewal initiatives, targeting dilapidated districts for redevelopment into affordable and rental housing. A commitment to complete stalled projects was reiterated, backed by expanded access to the existing bailout mechanisms. Monetary easing signals included potential reserve ratio cuts and targeted lending facilities, while fiscal measures hinted at increased special bond quotas for 2026. Cities like Guangzhou and Shenzhen further relaxed purchase restrictions, allowing non-residents multiple acquisitions in certain districts. Yet these steps met with muted market response. Transaction volumes in Tier 1 cities rose modestly in early December but remained well below prior year levels, and developer financing, though improved via whitelist approvals, covered only a fraction of needs. As the year ended, full-year estimates crystallized. Fixed asset investment was on course for a 2-3% annual contraction, the first since 1998, with real estate investment down approximately 10%, infrastructure flat or slightly negative, and manufacturing providing the sole offset through high-tech upgrades. Property sales nationally approached a 15-20% decline, prices in 68 of 70 monitored cities falling year-on-year, and unsold stock exceeding 7 billion square meters. The crisis's terminal characteristics became evident, not a cyclical dip, but a secular shift where excess capacity met demographic headwinds and deleveraging imperatives. Under-examined elements sustained this entrenched downturn. Local government financing vehicles, burdened by 90 trillion yuan in obligations, curtailed new borrowings under central directives, starving infrastructure of momentum. Hidden debt resolutions, involving swaps into official bonds, alleviated immediate defaults but constrained proactive spending. Demographic pressures intensified, with the working-age population shrinking by over 5 million annually and household formation rates halved, underlying demand evaporated, rendering inventory digestion protracted. Policy transmission lagged due to banking caution. Despite directives to lend, institutions prioritized risk amid rising non-performing loans tied to property exposures. Social dimensions, often overshadowed, amplified the stasis. Mortgage boycotts on unfinished projects persisted into late 2025, encompassing hundreds of developments and eroding systemic trust. Youth unemployment, hovering above 15% officially, deterred household formation and property purchases, while wealth effects from falling home values suppressed consumption elsewhere. The global ramifications deepened as the year closed. Commodity markets absorbed sustained weakness. Iron ore prices lingered below $100 per ton into December, copper demand forecasts were revised downward, and steel exports surged as domestic mills sought outlets, pressuring producers from India to Europe with deflationary flows. Supply chains adjusted to reduce Chinese capital expenditures, with multinational firms accelerating diversification. Emerging economies tied to belt and road infrastructure faced delays, while advanced nations contended with imported disinflation, complicating monetary normalization. Geopolitically, the slowdown reinforced Beijing's inward focus, accelerating self-sufficiency drives in semiconductors and renewables, potentially heightening trade frictions. Environmental goals, though reaffirmed, encountered budgetary trade-off. FS, with green infrastructure allocations, competing against stabilization needs. In this reflective conclusion to 2025, China's fixed asset investment collapse and the terminal evolution of its real estate crisis emerge as a pivotal inflection in the nation's development trajectory. The November data, with its unprecedented monthly plunges, and December's policy pledges mark not an endpoint but a prolonged plateau, where structural excesses confront irreversible constraints. The government's pivot toward renewal and affordability signals adaptation, yet recovery hinges on profound rebalancing, resolving local debts, stimulating consumption through social safety nets, and embracing demographic realities. Terminal, in this context, denotes not oblivion but transformation, a painful but necessary shedding of an unsustainable model. China's historical capacity for reform suggests potential reinvention, channeling resources toward innovation, services, and sustainable urbanization. Globally, the episode cautions against over-reliance on single growth pillars, urging diversified resilience. As cranes stand silent this holiday season and families await long-delayed homes, the narrative transcends economics. It is one of recalibration, where past triumphs inform future prudence. The real estate crisis, once a driver of ascent, now compels a broader reckoning, reminding us that enduring prosperity demands equilibrium between ambition and restraint. In the quiet of December 25, with data confirming contraction and policies charting cautious paths, China's story continues, not in collapse, but in measured evolution toward a more balanced horizon. As December 25, 2025, marks the end of a year that has tested the foundations of China's economic model like no other in recent memory, the collapse in fixed asset investment and the deepening terminal crisis in real estate have entrenched themselves as enduring structural realities, with late-year policy efforts yielding only limited stabilization rather than meaningful reversal. The cumulative January to November data confirmed a 2.6% year-on-year contraction in fixed asset investment, the most severe on record for that timeframe, while real estate investment alone fell 10.4% over the same period. New home prices continued their downward trajectory, declining 2.4% annually, with secondary market transactions in most cities registering sharper drops. In the closing days of December, the Central Economic Work Conference's commitments to urban renewal and affordable housing initiatives provided a framework for 2026, yet market indicators and analyst projections pointed to continued contraction, underscoring a crisis that has transitioned from acute distress to a prolonged, systemic adjustment. The final weeks of 2025 offered little respite. Standalone November figures had already revealed the intensity, an 11.1% year-on-year plunge in fixed asset investment, the deepest monthly decline documented, accompanied by an 18% reduction in property completions and a 27% drop in new construction starts. Sales volumes among leading developers contracted 36% annually, pushing unsold inventory to a record 27 months of potential absorption. Firms such as Vanke navigated acute liquidity challenges, engaging in asset sales and debt negotiations to avert default, while regional developers faced accelerated insolvencies. Local authorities, grappling with land revenues at half their 2021 peaks, postponed or scaled back infrastructure commitments, further weighing on overall investment activity. December's policy landscape intensified with the outcomes of the Central Economic Work Conference, convened mid-month. Authorities articulated a multifaceted approach for the coming year, prioritizing large-scale urban village redevelopment and the transformation of outdated districts into modern, affordable residential zones, expanding support for completing stalled projects through enhanced financing channels, and promoting rental housing as a parallel track to ownership. Monetary authorities signaled readiness for further reserve requirement reductions and targeted credit facilities, while fiscal plans included potential increases in special local government bond quotas to fund qualifying initiatives. Major cities, including Beijing and Shanghai, implemented incremental relaxations, such as reduced down payment thresholds for certain buyers and eased restrictions on multiple property ownership in peripheral areas. These measures aim to restore confidence and stimulate measured demand without reigniting speculative excesses. Nevertheless, immediate market reactions remained subdued. Transaction volumes in first-tier cities registered modest upticks in early December compared to November lows, but stayed substantially below prior year benchmarks. Developer bond issuances and bank lending under whitelist programs increased marginally, yet covered only a portion of outstanding needs. Full-year aggregates solidified. Fixed asset investment concluded with an estimated 2.5 to 3% annual decline, the first outright contraction since the late 1990s, with real estate investment down around 10%, infrastructure marginally negative, and manufacturing providing the primary counterbalance through investments in advanced sectors like electric vehicles, semiconductors, and renewable energy equipment. Property sales nationally finished approximately 18% lower, prices declining in 69 of 70 monitored cities, and vacant stock exceeding levels sufficient for several years of normalized demand. Less discussed dynamics continued to anchor this persistent downturn. Local government financing vehicles, carrying obligations estimated at 90 trillion yuan, operated under stringent central oversight that curtailed new debt issuance, limiting their capacity to initiate compensatory infrastructure. Debt swap programs, converting hidden liabilities into official bonds, mitigated default risks but constrained discretionary expenditure. Demographic realities deepened the structural mismatch. An aging population and declining household formation rates, exacerbated by birth rates remaining near historic lows, diminished organic demand, while the existing overhang of 7 billion square meters of housing stock rendered rapid inventory clearance improbable. Banking sector caution further impeded policy transmission. Despite directives to extend credit to viable developers and projects, financial institutions maintained elevated risk premiums amid rising non-performing loans linked to property exposures. Social undercurrents, including lingering mortgage payment suspensions on unfinished developments and elevated youth unemployment deterring major life decisions like home purchases, perpetuated a cycle of restrained consumer behavior and eroded systemic confidence. The global consequences solidified as the year closed. Commodity markets endured prolonged softness. Iron ore averaged below $100 per ton into late December, copper outlooks were downgraded, and excess Chinese steel production flooded export channels, exerting deflationary pressure on international producers. Multinational supply chains adapted to diminished capital outlays in traditional manufacturing, accelerating relocation trends. Belt and Road recipients experienced project delays due to reduced outbound investment, while importing economies benefited from lower input costs at the expense of domestic industry strains. Geopolitically, the slowdown reinforced priorities of technological self-reliance, channeling limited investment towards strategic sectors and potentially intensifying trade frictions over subsidies and market access. Environmental ambitions, though reaffirmed, confronted fiscal trade-offs, with green infrastructure competing against immediate stabilization imperatives. In this contemplative close to 2025, China's fixed asset investment collapse and the terminal phase of its real estate crisis represent not merely a cyclical correction, but a profound reorientation of an economic paradigm that propelled decades of unprecedented growth. The November and December indicators, record monthly declines, persistent inventory buildup, and cautious policy responses, affirm a landscape where overcapacity, leverage, and demographic shifts converge to demand fundamental adaptation. The conference's emphasis on renewal and affordability charts a pragmatic course, yet meaningful recovery necessitates broader reforms. Comprehensive local debt resolution, enhanced social safety nets to bolster consumption, and acceptance of slower but more sustainable growth trajectories. Terminal, in this context, signifies the conclusion of an era defined by investment-led expansion, clearing space for a more balanced model centered on innovation, services, and household well-being. China's proven adaptability in prior transitions offers grounds for measured optimism. Resources redirected toward high-value industries and urban quality-of-life improvements could seed renewed vitality. Globally, the episode serves as a cautionary narrative on the perils of sectoral over-reliance, encouraging diversified strategies and cooperative mechanisms to manage spillovers. As families gather this December 25 amid unfinished skylines and recalibrated expectations, the story transcends statistics. It is one of resilience amid transformation, where the lessons of excess inform the architecture of tomorrow. The once ubiquitous construction cranes may pause, but the nation's capacity for reinvention endures, reminding us that true progress lies not in perpetual ascent, but in equitable, enduring foundations. As December 25, 2025, brings the curtain down on a year of unrelenting economic challenges for China, the collapse in fixed asset investment and the terminal descent of the real estate sector have cemented their status as the dominant forces reshaping the nation's growth trajectory, with policy responses in the year's final days offering a blueprint for managed decline rather than robust revival. The January to November aggregate showed fixed asset investment contracting 2.6% year-on-year, a figure that solidified projections for the first full-year decline in decades, while real estate investment registered a 10.4% drop over the same period. Home prices persisted in their erosion, down 2.4% annually, with transaction volumes and developer sentiment reflecting entrenched caution. The Central Economic Work Conference's mid-December conclusions, prioritizing urban renewal and stabilization measures for 2026, framed an approach centered on containment and gradual rebalancing, yet prevailing indicators suggested only modest mitigation of the downturn's momentum. Year's denouement reinforced the crisis's severity without dramatic new ruptures. November's isolated metrics had already highlighted the acute phase, an 11.1% year-on-year nosedive in fixed asset investment, the most abrupt monthly contraction on record, coupled with sharp reductions in property completions and initiations. Leading developers endured sales declines exceeding 35% annually, elevating unsold inventories to unprecedented absorption horizons. Entities like Vanke progressed through restructuring dialogues and selective asset disposals to preserve solvency, while regional operators contended with mounting resolutions of distressed obligations. Local fiscal entities, operating with land-derived incomes substantially diminished, maintained deferrals on planned works, perpetuating the drag across broader investment categories. December's authoritative gatherings yielded a structured outlook. The conference articulated commitments to expansive redevelopment of urban villages and substandard neighborhoods, envisioning conversions into affordable ownership and rental accommodations. Emphasis was placed on expediting delivery of pre-sold, but incomplete units via augmented funding conduits, alongside cultivation of a professionalized rental market to diversify housing options. Supporting signals encompassed prospective adjustments to bank reserve ratios, specialized credit instruments, and elevated allocations for local special purpose bonds in the forthcoming fiscal cycle. Metropolitan centers, including Tier 1 hubs, introduced calibrated easings, lower initial payment ratios for qualifying purchasers, and softened limits on additional acquisitions in select zones. These interventions sought to nurture incremental demand while guarding against renewed speculative pressures. Market feedback, however, remained tempered. Early December saw slight elevations in transaction activity within premier cities relative to November troughs, yet levels persisted markedly below historical norms. Financing inflows to approved projects expanded incrementally, but addressed only partial requirements. Annual summaries coalesced around a 2.5 to 3% contraction in fixed asset investment, the inaugural yearly retreat since the late 20th century, with real estate contributing a double-digit reduction, infrastructure essentially stagnant or marginally recessive, and manufacturing furnishing the principal buoyancy via allocations to strategic domains such as new energy vehicles, chip fabrication, and sustainable power apparatus. National property transactions concluded roughly 18% diminished, price indices lower in the vast majority of tract locales, and vacant floor space surpassing multi-year clearance thresholds. Underlying currents sustained the impasse. Local government financing platforms, encumbered by liabilities approaching 90 trillion yuan, navigated restrictive central guidelines that suppressed fresh indebtedness, thereby circumscribing compensatory initiatives. Liability conversion initiatives eased proximate pressures but delimited expansive outlays. Demographic imperatives grew more pronounced. Contraction in prime working cohorts and subdued household establishment patterns, compounded by fertility metrics near nadir, eroded foundational requirements, prolonging surplus assimilation. Institutional prudence in lending perpetuated transmission frictions. Notwithstanding mandates to support credible ventures, banking entities upheld stringent appraisals amid escalating impaired assets connected to sectoral exposures. Societal facets, encompassing residual payment withholdings on delayed constructions and persistent elevated joblessness among younger demographics, reinforced cycles of deferred expenditure and diminished institutional credibility. International repercussions consolidated through the year's terminus. Primary input markets absorbed ongoing tepidity. Ferrous ore valuations hovered sub $100 per ton into late December, base metal projections moderated, and surplus domestic metallurgical output intensified outbound shipments, imparting disinful. Asianary influences on global counterparts. Transnational production networks accommodated curtailed traditional expansions, hastening reconfiguration. Infrastructure recipients under outbound initiatives encountered postponements attributable to constrained capital flows, whereas recipient economies gained from moderated commodity expenses amid domestic sectoral adjustments. Strategically, the deceleration bolstered imperatives of autonomous advancement, directing scarce resources toward critical technologies and possibly amplifying commercial disputes concerning assistance and access. Sustainability objectives, while reiterated, navigated resource allocations, contending with pressing equilibrium demands. In this measured valediction to 2025, the implosion of China's fixed asset investment and the terminal maturation of its real estate predicament constitute a seminal juncture in the chronicle of its modernization. The culminating metrics and deliberative outcomes delineate not cataclysm but calibrated transition, wherein accumulated imbalances encounter inexorable limits, mandating systemic reconfiguration. The conference's orientation toward refurbishment and accessibility delineates a viable orientation, albeit one contingent upon exhaustive overhauls. Thorough provincial obligation remediation, fortified welfare frameworks to invigorate domestic absorption, and accommodation of moderated yet resilient expansion velocities. Terminality here connotes the cessation of a protracted investment-dominant epoch, liberating capacity for equilibrated configurations, emphasizing ingenuity, tertiary activities, and societal welfare. The polity's demonstrated dexterity across antecedent junctures furnishes basis for guarded assurance, reoriented expenditures into elevated value pursuits, and livability enhancements may cultivate emergent dynamism. Internationally, the occurrence imparts admonitory insight regarding singular pillar vulnerabilities, advocating variegated fortitude and collaborative modalities to attenuate externalities. As households convene this December 25 amidst paused construction vistas and tempered prospects, the chronicle surpasses numerics. It embodies fortitude within metamorphosis, wherein antecedents of proliferation guide forthcoming sagacity. The erstwhile omnipresent hoists may repose, yet the collective aptitude for renewal persists, affirming that authentic advancement resides not in ceaseless escalation, but in harmonious, perdurable underpinnings.